Well, good afternoon, everybody, and welcome to Gray & Gray's webinar on the new National Franchising Financial Standard. My name is Mark Keshkagian, and I'm one of the partners who oversees our firm's McDonald's practice group. We are very pleased to have so many McDonald's owner-operators from around the country with us today. We appreciate all of you for taking the time for this very important presentation. Today's subject matter is clearly the concern of many owner-operators, as this is one of the largest audience we've had participate in the last few months. By the way, this is the last in the series of webinars before the Worldwide Convention. And if anybody has any questions about today's information, please feel free to reach out to me here at Gray & Gray or at the Worldwide Convention in a few weeks. We'll be there, and we're very excited to be participating in the Worldwide. We'll be at booth number 440A, which is between Treasury and the New Futures area. We will begin our summer webinar series in June, so please look for more details in the coming weeks. Now on to today's topic, the new National Franchising Financial Standard. One technical point before we begin: if you have a question during the webinar, please feel free to click on the Raise Your Hand button and type in your question. I will get to it either during the presentation or at the end, whichever is most appropriate. One other thing that I do want to do is just tell you that last week, unfortunately, I was sick for 5 days, diagnosed with the flu. So I am back in my office. However, my voice is a little weak, and sometimes I do engage in a little coughing fit. So if that happens to happen, bear with me. I'll mute, and then I'll be back in no time. This morning's webinar, which was hugely attended, I actually got away with not coughing, so that was a good thing. Let's hope that happens today. So, on to this new financial franchising standard. Before we begin, I just want to give you my personal opinion on this. You know, the old system, under the old system, you know, we were looked at based on 3 ratios: cash flow coverage, liability turnover in days, and working capital, obviously, and then obviously debt to equity. Those haven't changed. But before, under the old system, if any one of those ratios dipped below McDonald's guideline, you could be deemed ineligible. Your viability could be deemed in a negative way. Today, under the new system, it's a much more holistic approach. So they look at all 3 of these ratios collectively. You know, so for instance, and I'm sure you've heard this, you know, now 1.2 necessarily isn't where you need to be. You can dip below 1.2, and your cash flow coverage ratio can go as low as 1.0, but as long as you have working capital, strong working capital in your organization, they consider that less risky. And we'll get into that in more detail as we move through today's presentation. But from a professional opinion, I think it is a much better way at looking at the health of an organization, is to be able to look at it holistically and take all 3 into consideration rather than one on its own. So let's kind of review quickly what the standard says. The vision is that owner-operators are financially healthy and successful. The purpose is that owner-operators are capable of growing and reinvesting in their restaurants by optimizing and managing all financial aspects of their business. And then obviously the standard is that owner-operators operate a financially viable restaurant business, meet all of their financial obligations, and be credit-worthy in order to meet ongoing and future business needs. So let's talk a little bit about measurement and guidelines. Financial viability of the restaurant business is determined by an overall point system applied to the individual viability measurements. The individual financial viability measurements are as follows, and we kind of went over that. Cash flow coverage ratio greater than or equal to 1.2. Trailing 12-month, and I note trailing 12-month because that's different. We're going to talk about that later on. Trailing 12-month liability turnover equal to 7 days or less, and equity greater than or equal to 25%. So those metrics haven't changed. 1.2, 7 days or less, greater than 25%. When we talk, actually let me back up one slide. When we talk about cash flow coverage, I kind of want to just dive into each one of these quickly in case you don't have an understanding of what these are there for. Cash flow coverage ratio is really a measure of a company's ability to meet its financial obligations. Obviously, the higher the coverage ratio, the better the ability to fulfill its obligation to lenders. For example, let's say that our debt service, our principal and interest payments on an annual basis are $10,000. What a 1.2 cash flow coverage ratio means is that for every $10,000 of debt service, our organization should be generating $12,000 in pre-debt cash flow after G&A and draw. What that means is that a 1.2 allows for extra cash, building of cash in the organization. In the example that I just showed you, an extra $2,000 of cash. Why? For unforeseen expenditures, road closures, something happens in the store, a system initiative, a piece of equipment that breaks down that needs to be replaced. That's why McDonald's and lenders like to see that cash flow coverage ratio greater than 1.0. 1.0 would mean you're generating enough cash to pay your G&A, to pay your draw, and to pay your debt service. But 1.2 allows for a little bit more. Also, when we talk about working capital and the trailing 12-month liability turnover, working capital is really a measurement of a business's ability to pay its 30-day liabilities. Those are its current liabilities. The primary reason people look at a balance sheet is to determine a company's working capital or what is its current position. The target for your working capital ratio is to be greater than 0 or positive, meaning that we should have cash in our organization. When you look at your balance sheet and you compare your current assets to your current liabilities, your current assets meaning your cash, your inventories, your prepaid expenses, those things compared to your current liabilities, your accounts payable, all your accrued expenses, and the short-term the 1 month short-term portion of your loan. That should be a positive number. We should have more cash in our organization. McDonald's guideline calls for working capital to be greater than 0, which means that there should be at least $1 or more in total current assets for every dollar of current liabilities. Going hand in hand with working capital is what we call the liability turnover in days, which calculates the number of days of next month's sales that are needed to meet this month's liabilities. For example, let's say your working capital isn't positive. Let's say that it's negative, that you have more current liabilities than current assets. What McDonald's is saying with this 7 days or less is you are allowed to go into next month's sales and use 7 days of those sales to pay the current month's bills. Anything deeper than 7 days obviously would be a problem. But the best thing to have is positive working capital, so you have negative days. We'll go into that in a little bit. In other words, how long will it take you to earn enough revenue to pay off the bills you will accumulate during the month? When we talk about equity, equity is a leverage ratio. It talks to us about how the business is leveraged. For example, your business may be worth $20 million. That's the equity value in your business. You may have $10 million worth of debt. In simplistic forms, your debt-to-equity ratio would be 50%. Your value is $20 million, your debt is 10, debt-to-equity would be 50%. $10 million is 50% of 20. So I just kind of wanted to give you a quick brief overview of those three. So the number 6 is going to become a very important number as we move forward. An organization must achieve an overall score of 6 or greater to meet the financial viability standard. Let's look at the metrics, and I'm going to turn on my little spotlight. Hopefully you guys can see the little red spotlight there as we move through. These are the metrics of the new franchising standard. Cash flow coverage ratio, obviously. Here's your point totals. Anything less than 1.0 you'd get -1 point. So that's not a good thing to be less than 1.0. That means that your business is not generating enough cash to pay its debt, to pay G&A, and to pay draw, and obviously all of its expenses. 1.2 to 1.39, you get 3 points. Anything above 1.4, you get 4 points. Now, you actually do get points for cash flow coverage ratio numbers that dip below 1.2. So from 1.1 to 1.19, you get 2 points. 1.0 to 1.09, you get 1 point. It's important to remember those metrics. When we look at liability turnover ratio in days, it's now a trailing 12-month liability turnover in days. Positive days indicate degrees of positive working capital. Negative days indicate a traditional liability turnover. So negative days means that we are dipping into next month's sales to pay current month liabilities. As you can see down here, greater than 14 days or higher, negative, means you get -2 points. That's not a good situation if you have to go into next month's sales by 2 weeks or more to pay the current month's bills. Greater than 7 days up to 14 days, you get 0 points. So it doesn't affect you positively or negatively. The standard as we know it now, greater than 0 to up to 7 days negative, you get 2 points. 0 to 10 days positive, that means you now have positive working capital, so you have positive days. You get 3 points. Anything greater than 10 days positive, you get 4 points. So obviously this new system encourages you to build cash in your organization. I can remember as an accounting student 35 years ago, sitting in Accounting 101, my professor telling us, and I remember hearing it for the first time, cash is king. And he explained to me that as you go through your professional career, you're going to understand that cash is king. Well, today in our business, in McDonald's business, in my accounting firm, cash is king. It's so vitally important to build cash in your organization. It takes the risk out of things that would lower your cash flow coverage ratio. When we look down here at equity, anything 25% to 70%, which is today's metrics, you get a point for. Anything greater than 70%, you get 2 points. Anything that's less than 25%, you get -2 points for. These are the metrics that are used. This is the points that are attributed to the different levels within these metrics. It's important that you print this out and you have this at least by your side so that when you're looking at your ratio report, and by the way, a little bit later in the presentation, we'll be looking at the current ratio report and going through it, you at least understand where these point totals are coming from. Other things to consider, I got to turn off my little spotlight for a second. Other things to consider here are submit timely and accurate financial statements to McDonald's. That hasn't changed. That was in the old standard, and it's in the new standard as well. And that you pay McDonald's and others on time. So these things haven't changed. The calculation of the ratios has not changed either. The new system attributes a point value to a range of the value of the ratios, as we just saw on that last slide. The new system allows an owner-operator to have a cash flow coverage ratio of 1.0 to 1.2 as long as they have positive trailing 12-month working capital and equity greater than 70%. The new system provides owner-operators with the potential to pass when they would have been ineligible under the old system. And like I said before, building cash in your organization leads to less risk when dealing with viability. So when we talk about pass, it's important to know that 6 points or greater is considered a passing viability grade. 5 points is considered a gray area. They call it a warning area. And 4 points or less is considered failing. So again, 6 points or higher is passing. 4 points or lower is failing. 5 points is a warning. They also have what they call the gold standard. If you have 9 points or better, you're considered to have the gold standard. This slide is very important. Under the new system, the liability turnover in days metric is now being measured, as I said, over a trailing 12-month period, not at the time of measurement. This may have a significant impact on viability, as a greater emphasis has been placed on maintaining positive working capital in your business throughout the year rather than at a point in time. Let me give you a quick example. Some of you may have, in the past, if your cash flow coverage ratio wasn't 1.2 and it was lower, some of you may have injected cash in your business to bring that cash flow coverage ratio up over 1.2. Some of you may have had situations in your organization where your working capital was negative and that you needed to inject a sum of money to bring that number to a positive number so that your viability would be positive. That is considered, those events they happened and you got immediate impact on that, a positive impact on injecting cash in the business. Today, because we're looking at a trailing 12-month period when we talk about the liability turnover in days, if you're injecting cash into your business because you have negative working capital, you want to make it positive, you're no longer going to get that immediate impact. Now, rather than it all of a sudden falling on that month and giving you a positive impact, you're only going to be able to reap the benefits of 1/12 of that impact. It may take 12 months to get the full impact of that cash injection. Now, I'm not saying that it's a bad thing, but what I am saying is you have to look at some of the things that you're doing in your organization or that you've done in your organization in the past and how that's really going to have an effect on your viability. Let's look at a couple of examples. This is under the old system prior to April 1st. If you had a cash flow coverage ratio of 1.2 or better, you were good. Under the new system, you get 3 points. If your liability turnover in days was 0 days up to 7 days negative, you were good. Today you get 2 points for that under the new system. In equity, 25% or greater, you were good. Under the new system, you get 1 point for being 25 to 70. So you get 6 points. So if you had all of these metrics met under the old system, you will still have your 6 points under the new system. Now let's look at these new guidelines as of April 1st. The scenario below exemplifies how the new system allows an owner-operator to have a passing score with a cash flow coverage ratio below 1.2 as long as they maintain positive trailing 12-month working capital and equity greater than 70%. In this example, now we've dipped below 1.2 and we have cash flow coverage ratio of between 1.0 and 1.09. You get 1 point for that. But if you know in your organization you have positive working capital, therefore your trailing 12-month liability turnover in days is 0 to 10 days positive, you get 3 points. And if your equity is greater than 70%, you get 2 points. Again, a total of 6 points. Dipping below 1.2, you can still get 6 points. There's so many different variations that we could go through right now, and the point is to understand how your numbers are calculated and what types of transactions that you can do in your business that can positively or negatively affect that point total. Right now on my desk, I'm looking at what we call it's kind of a watch list. Every month we take all of our clients in all of our regions and we look at their total point total right from FFS, from the ratio report, which we're going to look at in a few minutes. And then we look at their cash flow coverage ratio. We look at their trailing 12-month liability turnover in days number, and we look at their equity percentages. Well, I can tell you that generally speaking, for most of our McDonald's owner-operators, and when I say most, I'm talking about 86% of them don't have issues with equity. They have at least 25% 8% or higher in equity. Where we seem to see problems when it comes to the point total and what affects that is with the cash flow coverage ratio. But the other thing that I'm looking at is we also create two other schedules for all of our clients. One that shows the debt that retires in 2014, the debt that retires in 2015, and the debt that they may have retiring in 2016. We also look at fluctuations in draw. We look at their trailing 12-month draw pattern, and there may be situations where they injected cash in their business, and it's very important to note that if that was done at some point in time, 12 months later, that injection of cash is going to fall off the radar screen, and it could affect draw in a negative way. So we actually track these fluctuations to make sure that we know what's coming down the line for our owner-operators. The other thing that fluctuates in draw a lot is with taxes. Last April, you may have had to pay, let's say, $60,000 in taxes when you filed your tax return. This April, that number may only be $15,000. So there's a positive fluctuation of $45,000 between last April and this April, which may have a positive effect on your financial viability standard. So we're looking at all these things on a monthly basis, and you should be asking your CPAs to do the same, because it's very, very important for you not only to know what your point total is today, but what your point total is going to look like next month, 3, 6, 9 months from now, a year from now, 2 years from now. And we've created Excel spreadsheets that actually help us to calculate our point totals for all of our clients over a period of time, so that we can see the fluctuations that could be taking place. As I said, be sure to check with your CPA and your financial advisor to understand your financial viability under the new 6-point system. Now, let's have a little bit of fun. This is the new ratio calculation sheet that was rolled out effective April 1st. I think this was available to us in March. So up top here is kind of the summary area. Talks about estimated net equity, cash flow coverage ratio, and trailing 12-month liability turnover in days. And as you can see, the estimated net equity calculation is not shown. What they do show, and follow the red dot, what they do show is what the results were. And in this case, this owner-operator, who happens to be named Ronald McDonald, this owner-operator has equity between 25 and 69.9%. Therefore, based on the metrics I showed earlier, they get 1 point for that. But the company doesn't show that calculation. And they don't show it for, I'm sure, a variety of reasons. One of the things is that what goes into that calculation is required reinvestment. I don't know what that number is for all of the stores that my clients own. I'm sure that some of my clients don't necessarily know what the NRBES is for their restaurants. I'm not sure what the company uses. I will tell you this, I am going to be convening with the company's financial team and all the nation's finance directors in June. We're going to be collaborating on a variety of issues to help our owner-operators. One of the big questions I have is, why isn't this calculation being shown, and in fact, how is it calculated? Because that's very important for us to know. I hear lots of things. I hear that some regions use they don't put in required reinvestment, but they use ongoing reinvestment of $20,000, $30,000, $35,000, trying to get a little bit better understanding on that. And during our summer series, when we dive deeper into viability, we'll hopefully have some good information from those June meetings. Cash flow coverage ratio, that number is calculated and is shown as it was in the past. In this example, cash flow coverage ratio was 1.25. And based on the metrics that I showed earlier, the financial viability assessment is a total of 3 points for 1.25. Liability, trailing 12-month liability turnover in days, that used to be calculated. Now they basically show how it's calculated, and they give you the point total. We can still calculate that number, but it's a just is number anyway. There's nothing to be concerned with the calculation. It is what it is, and we're gonna show you something on the next sheet, the next slide that we go to. But in this case, 4.4 means that it's 7 days or less. 4.4 would be a total of 2 points. In this situation, the owner-operator has 6 points. So they would pass. Now, very, very important. A lot of people don't understand this, but this is very, very important. On this ratio sheet, there are now 2 tabs. It used to only be this sheet, but now in the bottom left corner of your ratio report, there are 2 tabs. And the next tab, I just have to turn off my little spotlight for a sec. The next tab brings you to what we call the balance sheet. And that's what this is, the trailing 12-month balance sheet. And I am only showing a piece of this because I wanted to make sure that you could see the numbers so that I could pretty much describe what's going on here. So this is the bottom half of the balance sheet. You're not seeing the asset side. But what's really important is down here. Okay, this area here, working capital and below. Like I said earlier, this ratio was calculated as of a point in time. Now it's no longer done that way. It's now a trailing 12-month calculation. So it's looking back 12 months. So now as you can see on this balance sheet, it shows what your working capital is every single month. In this situation, you have some negative numbers. But the average daily sales of the organization, and let's just go back one slide quickly. Oops, I'm sorry. Right here, you can see that the average daily sales are annualized based on taking total sales divided by 363 days. That's how McDonald's Corporation determines what your average daily sales are for your organization. They take the annualized sales and they divide that by 363. So moving forward again, let me get my little spotlight back on. In this case, the average daily sales, they fluctuate month to month based on trailing 12-month data, but it's around $60,000. So when you look at the liability turnover ratio, in this case, it's 3.1. In this case, it's 8.2, 4.5, 3.9, 5.1, 3.5. So trailing 12-month liability turnover is 4.4 days. And that's what we used in the example on the previous page. But one of the things that I do want to say is if, in fact, like I mentioned earlier, if you were deciding to inject capital into the business to positively affect your working capital, normally you would see this draw number, because anytime you inject capital into the business, it affects your draw. That would become a negative number. This number, this liability turnover in days now, because this working capital number would be much better, this number would be a better number as well. And you'd get an immediate effect of injecting that cash. Now, you don't get that immediate effect. It's actually divided. You get 1/12 of an effect of that over a period of time. That might be a little bit hard to understand. If anybody is having any difficulty with that, feel free to reach out to me. But this is really, really, really important. I can't stress this enough to understand that liability turnover in days is now being calculated as a trailing 12-month calculation and no longer as of a point in time. It's very important that you understand that. Let me turn off my little spotlight. Okay, so because we have a lot of people on the call, we have a few questions that have come through that I do want to get to before we get too late into this webinar. First question that came across is, what if I'm a 5? So this owner-operator is asking, what if I'm a 5? That's a great question. I will say this. I don't know that I necessarily have the answer, but I will say this. If you're a 5, you're in that gray area, you're in that warning area. What I think happens is the regions probably look at why you are a 5. What in your organization is creating that 5? Is it that your store profitability is down? Is it that your G&A is high? Is it that your drawer is high? Is it that you have a tremendous amount of debt because you've done a lot of reinvestment projects over the last 2 or 3 years? So they'll look at what's creating that score of a 5, and they'll probably engage in a discussion about what is your plan to improve any one of those areas. I think it's a great question. I'm also in June going to ask that question when I sit down and meet with the finance directors across the country, because I really do want to know what happens if you are a 5. I hope I answered that question for you. The other question that just came through is, what if I'm a 4? Question number 1 is, what if I'm a 5? So that's a great question. 5 is considered a warning. I don't know the answer to that. As I said, a company, or what the regions do, is they look at what creates the 5. They look at your profitability, they look at your G&A, they look at your draw, they look at your debt service. And a 5, and I know I may be repetitive, the regions will look to see what creates that 5. But let's get back to the next question. What if I'm a 4 or less? Is there a way that I can make it a 6? So the answer to that question is yes. As a CPA, I would sit down, and I'm sure your CPA would do the same, but find out what's creating that 4, what's creating that score that's not a pass score. It could be, again, a significant amount of debt. It could be G&A, it could be draw, it could be the profitability in the restaurants. But what you really need to do is to have a plan in place. There could be debt that's retiring this year or next year. You probably want to look at the norm reports to see what the profitability of the restaurants are. You may want to look at the contribution margin to see if that's comparable. The quintile reports are outstanding reports. Unfortunately, the CPAs do not have access to those reports yet, but we do have access through our clients. They're great reports. I would look at the quintile reports. They talk a lot about some of the metrics that affect the cash flow of your restaurants. I would look at G&A. I'd look at draw. I mean, in a downturn in the economy or in the business, we do have to make adjustments. You know, as a partner in a CPA firm, if our cash situation is off, we have to make adjustments. Very important to look at all these things and take all these things into consideration. But absolutely, you can put a plan in place to make that failing score a passing score. At this point in time, I don't have other questions. I just had those 2. Again, we are going to be at the Worldwide at booth 440, located between Treasury and Futures. Excuse me 1 second while I cough. I hope you can come by and visit us. We have a lot of nifty tools. Feel free to come by with your ratio reports. If you're having a hard time understanding the whole point total thing, we can walk you through that. We actually will have a ratio calculator there as well that'll help you to understand some of the things that you do in your organization that can positively or negatively impact any one of your ratios or your viability standing. So feel free to come by. We'd love to help you out. There's our contact information. I will reverse back to my email address as well. Again, feel free to reach out to me. You can either call me or email me. I'd love to help you out. This is really fresh. This is new stuff. And you know, as an owner-operator, I'm sure you're expected to understand every aspect of the business. But most owner-operators don't have a financial background, and understanding these metrics and how certain things that you do in your organization can positively or negatively impact your viability is really important that you have an understanding of that. So again, use the resources that are around. Use your finance teams. Reach out to people like myself. Reach out to your CPAs, and really try to understand, put your arms around this new 6-point system, because it's very, very important to your growth and to your success as an owner-operator. Again, look forward to seeing you at Worldwide if you are going. If not, be well. Thanks for joining in today's webinar. And again, look for our summer series that we're going to be releasing soon. We've got some good material that we're going to be going over this summer. Again, thanks again for your participation, and we look forward to seeing you worldwide if you're going.